So you think that your money's safe just sitting in the bank. Well, it might be secure, but it's not growing. In fact, the bank is quietly flipping your deposits into profits, and they're really just handing you crumbs in return. So today we're breaking down exactly how banks profit off of your savings, and more importantly, what you can do to stop losing out. And I just have to say, the simple math I'll go over that explains what your bank is earning off of your money is absolutely shocking, and I bet it'll blow your mind. Ever wonder what actually happens to your money after you deposit it into the bank? Most people, they picture their cash just kind of sitting in a vault, right? Waiting for them to come back and grab it when they want. But the reality is a little eye-opening. So when you put your money into a savings or checking account, they actually use your cash to make loans to other people. So think about mortgages, car loans, or even credit cards. They charge those borrowers a much higher interest rate than what they pay you for keeping your money parked in their accounts. That difference is what they call the spread. And it's a huge part of how banks make their money. So let's break it down here with a really simple example, right? So suppose that you deposit $10,000 into your savings account and your bank pays you a 0.40% interest annually. Now that means after a year, you'll earn just $40 in interest. And meanwhile, the bank, they might lend that same $10,000 out as a car loan at a 6% interest rate. And on that loan, they'll collect $600 in interest from the borrower over the year. So they pay you $40, but they make $600 and they pocket the difference.
'Cause I'm a bad mother.
That's a 15x difference in earnings. Imagine if you were getting even a third of that return instead.
Exactly, Tiara. And it's a huge difference, but it doesn't stop there. Banks also make money by investing your deposits in things like government bonds or just other securities. And they charge fees for all sorts of services too. So like account maintenance, overdrafts, or wire transfers. We've all been hit with them, right? All of those streams, they really add up. But the real engine here is that spread between what they pay you and what they earn from lending out your money. Now, if this pisses you off, and it probably should, and you really want to control your own financial future, make sure that you hit subscribe, as I've got a whole lot more great info coming your way. Plus, I'm going to be publishing a video really soon that explains the dumbest moves that I've ever made in the stock market, which is definitely entertaining, but also educational to say the least. Now, in the next section here, we'll dig into why those low rates are such a bigger problem than you may realize, and how they can easily and quietly eat away at your financial growth. Okay, so question, have you ever checked your savings account and thought, wait, is that really all the interest that I earned this month? Well, you're definitely not alone. Most people, they don't realize just how little their money is growing in a traditional bank account. The average savings account in the US, it pays about 0.5% interest, and about 25% of Americans earn less than 1% on their savings. Meanwhile, inflation, basically, which is the rising cost of everything from groceries to gas, was up 2.8% over the past year, and it's expected to keep climbing. So if your savings are earning less than inflation, which according to the averages that we just went over, they are, you're actually losing money in terms of what you can buy. And even if your balance goes up a little bit, it doesn't matter because the buying power of the money isn't as good.
Prices keep going up. People's salaries, their income doesn't.
So why do banks offer such low rates in the first place?
Sweet mother of God, they are sons of
It's not just because they can, right? So traditional banks, they move slowly when it comes to raising interest rates, especially compared to online banks. And the reason is they know that most customers, they just won't switch, even if they're getting a bad deal. In fact, a recent Experian survey found that 40% of people stick with their low rate savings accounts because they don't think that they have enough savings to even bother switching. And 30%, they didn't even realize they should look for better rates. Banks are counting on you to stay put, even if it means that you're missing out. But the story, it doesn't end there, right? There's a powerful force here that's called compounding interest that should be working for you, not against you. And in the next section here, let's talk about how compounding can make or break your wealth and why the low rates from banks barely let you tap into its power. So let's talk about something that should be your best friend when it comes to building wealth, and that is compounding. Now, if you've ever heard someone say,
let your money work for you,
this is exactly what they mean. But the problem is if your bank is paying you next to nothing in interest, you're barely getting to see the results of compounding in action. So imagine compounding as a snowball rolling down a hill. At first, it's small and slow, but as it keeps rolling, it picks up more snow and grows faster and faster. That's what happens when you earn interest, not just on your original deposit, but also on the interest that your money earns over time. It's interest on top of interest, and it's how wealth can really start to multiply. The real magic of compounding, it happens when you have higher interest rates and more time. The more often your interest compounds, so whether that's daily, monthly, or quarterly, or even yearly, the faster your money grows. But if your bank only is, giving you scraps, you're missing out on the true power of compounding, and your wealth is basically going to be stuck in neutral, especially as inflation eats away at it. So here's the bottom line. Compounding is supposed to be your secret weapon for building wealth, but only if you're earning a decent return on your money. And that's exactly how low interest rates quietly sabotage your future, by muting the very compounding power that should be building your wealth. Now, in the next section here, we'll look at how traditional banks and opportunity costs can quietly rob you of your financial future if you aren't careful. So opportunity cost is just a fancy way of saying, what could I have earned if I put my money elsewhere? And when you let your cash sit in just a regular savings account earning less than inflation, you're not just missing out on a few extra bucks on the interest. You're giving up the chance to make your money actually work for you in better ways. So to show you some math behind it here, let's say that you keep $10,000 in a traditional savings account earning 0.5% interest. After a year, you'll have made about $50. But if you'd put that same $10,000 into a low-risk investment like a CD, a certificate of deposit, or a money market fund earning 4%, you'd make $400 in a year. That's a $350 difference in just 12 months. Over 5 years, that CD would end up making you just over $1,900 more than a traditional savings account. So yeah, the difference seems small, but it becomes staggering the more time goes on. And that's just one way that banks cost you money.
Now imagine you have $20,000 sitting idle. Double that opportunity loss. And suddenly you've paid for a used car by doing nothing.
Sure, TR. And granted, you may not get a super nice used car, especially nowadays, for that amount of money, but it is a good representation. And it's not just about the numbers either. Most people don't even realize they're actually losing money. They think that their money is safe in a bank, but it's actually losing value, and it's missing out on other potential growth due to inflation. And the longer that you wait to make a change, the more you're leaving on the table. So we know at this point that traditional banks, they just aren't cutting it, right? But what if artificial intelligence could do better than banks and many of the other investment strategies that I talked about here? Well, in this video right here, I handed $5,000 to artificial intelligence to invest, and what it purchased might surprise you.